Shane Oliver is the Chief Economist with AMP Capital. He says a hard landing for housing in Australia is unlikely, but the next move in interest rates will be down. Shane Oliver, the OECD has today warned that Australia may suffer a hard landing when it comes to housing. What does a hard landing look like to you?
Well, there's no precise definition, but I guess it would be something like what we saw in the US or in Europe around the time of the GFC. That's where house prices fall 30% or so. There's a significant contraction in housing construction activity. And of course, that all flows on to the rest of the economy in terms of problems for the banks, reduced consumer spending, reduced construction activity.
How likely is it?
I don't think it's the most likely scenario. It looks like nor does the Reserve Bank, but it's certainly a risk worth keeping an eye on. We are seeing quite sharp falls in house prices. We've seen a big reduction, almost a halving in auction clearance rates in the two major cities of Sydney and Melbourne. Obviously, all of this is flowing through to consumer confidence and wealth, and that's going to have a big drag on the economy through next year. But hopefully it won't turn into a hard landing, because we haven't quite seen the deterioration in lending standards we saw prior to the GFC in the case of the US. We haven't seen big rises in interest rates. We haven't seen a rise in unemployment causing people to default on their loans. So I'm pretty confident that we will avoid a hard landing for the housing market, but it's certainly a risk.
You've said that you now believe that the next move from the Reserve Bank will be a rate cut and not a rate rise. How soon do you expect this cut? And what is going to deliver it, given that, as you've mentioned, yes, we are seeing property prices come off, but the economy is still growing and we still have very low unemployment? Yeah,
certainly. It is the case that the economy is still growing and we still have low unemployment. My feeling, though, is that this weakness we're seeing in the housing market will continue through 2019 to the point that the Reserve Bank will start to question its own forecast regarding growth and particularly inflation. So the Reserve Bank will grow, in other words, increasingly concerned that the weakness we're seeing in housing will feed through to even lower inflation. And therefore, by the second half of next year, we'll come to the conclusion that it has to cut interest rates again, not to reignite the housing boom by any means, but really just to put more money into the hands of those Australian households with a mortgage, and that's about a third of them, basically to shore up consumer spending. So that's why I think interest rates will ultimately go down, but we're probably not going to see that until the second half of next year.
What difference would a rate cut make? And is there a risk that the RBA would send a very strong and negative message to households if they were to cut, which would then undo the work that a rate cut should have?
We do get to points in time, like we saw, I guess, back in 2011 and in the years subsequent to that, where the Reserve has to cut interest rates as the only way to try and help the economy. Yes, you can debate whether even lower interest rates will actually help things, but I think at the end of the day, if you've got a $400,000 mortgage, you cut mortgage rates by 0.25% in response to a Reserve Bank cash rate cut. That's roughly about $1,000 a year put into those households with that sort of mortgage. So it does put money back into the wallets of those households with a mortgage. And that's, I think, ultimately what the Reserve Bank would be aiming at doing here.
We're seeing an escalation of reports and negative sentiment coming through. And last week we had the RBA Deputy Governor, Guy Debelle, even mention the words quantitative easing. Is that counterproductive for the RBA to be even mentioning things like that?
I don't think it's counterproductive. I think what the Reserve Bank there is signalling is that it's aware of the issue. It's aware of the risk here. The RBA's baseline view, much like the OECD's, is that growth will hold up and that ultimately they'll be able to raise interest rates, which is what Guy Debelle said last week. But he said if things don't turn out that way, there are still plenty of things they can do. They can cut interest rates further. Don't forget, European interest rates, Japanese interest rates are around zero or slightly below, in fact. So we've got 150 basis points of easing that you could do if necessary. And he also said, well, many other countries have tried quantitative easing, and that's helped, certainly it did in the US, and we could try that as well. So he's not saying that that's what they're about to do. He's saying that if things do turn sour, we get that hard landing, in other words, in the housing market, then there are things that they can do, and therefore we shouldn't be overly concerned about it.
Flipping over to the markets, we've seen yet another big sell-off domestically today. But you've written in a recent note that the risk of short-term weakness remains, but you continue to see the long-term trend is up. Why?
Well, basically, when I look around the global economy, I don't see the conditions that are going to give us a global or a US recession. And even in Australia, I don't see a recession. We haven't seen enough monetary tightening. Interest rates in the US are not high enough to give us a recession. We don't have an inflation problem. We haven't seen lots of private sector lending. We haven't had overinvestment in sectors of the economy in the US, like housing or technology, that preceded the last two recessions there. Whereas when you go back historically, the really serious bear markets, this is where the market might fall 20%. A year later, you're down another 20 or 30%, like we saw at the time of the GFC. They've invariably been associated with a US recession. This time around, I don't see that.
Shane Oliver, thank you so much for your time.
My pleasure. Thank you.